What is going on, Future Focus family? My name is George. We talk about investing on this channel. Welcome to Future Focus Finance. If you have not been here before, today we're going to talk about my end of the year thoughts. We're going to kind of figure out exactly what we anticipate will be happening in the year that's coming. It's very important. All right. The worst is not behind us. And we're going to look at some charts. We're going to look at some data and try to determine what should we do? How should we invest? Should we invest at all? Should we be patient? Should we be overzealous and just jump in? Those are some things that we're going to explore. Before we get into that, if you haven't subscribed to the channel, go ahead, do that right now. I'll wait. All right, drop a like too. I'll wait. But I want to wish all of you a happy new year. I hope 2023 is bountiful and prosperous for every single one of you. You all deserve it. I know 2022 wasn't the prettiest year on record, but don't worry, you weren't alone in the pain that a lot of people felt. If you've been listening to the channel, then I know you have some cash on the side to take advantage of those opportunities that are going to come next year. And if you don't have a lot of cash on hand, just don't worry. Like the last thing you want to do is feel bad about yourself. No reason to feel bad. All right. We're going to talk about a lot of different outcomes, a lot of different things that could happen. But with all that said, let's get right into it. So the first thing we're going to look at is how did the year end? Well, the Dow ended down 0.22%, which wasn't that bad. The S&P 500 ended down 0.25%, and the NASDAQ ended down 0.11%. However, one thing you should know is that this was the worst year for the stock market, especially the S&P 500, since the financial crisis of 2008. So we had all 4 quarters that were down. So even though we had some great days, some bad days, we ended the year down almost 20%, which means we're on the cusp of being in a bear market. So just some things to take in mind there. So what can we gather from that? What is something that we can pull forward into next year or even in the future to try to determine how to take this information and how is it useful? Well, it's useful because there was a lot of days where people got overzealous and they jumped in because they saw the market was up 3%, 4%, 5%. And people naturally get this feeling like it's the end. Like you have to jump in. The bottom's been hit. We hit the bottom in the S&P 500 or in a particular stock that you were looking at. And then you're like, oh, I don't want to miss it. Fear of missing out. I know you've heard it. I don't want to miss that time. So I got to jump and throw my money in right now so it's not too late. But what happened consequently was, yes, you went up 5%. Maybe it went down 1% the next day. And maybe you were up 3% the day after that. But ultimately, it was still more of a decline. So one thing to pull forward and learn from this is that just because you have a lot of green days in a row or a week of all green, it doesn't mean that the coast is clear. All right. There is good days and good weeks and good months in a bear market. And that's exactly what we saw this year, which is great because it tells us that history is still repeating itself and rhyming with each other. So we can still use history as a barometer to try to identify what's going to happen in the future. And that is a positive. All right. So the VIX went up, not a lot. It was up 1%, but it's still above 20%, which is it's still above 21.67. 20 is that spot that we're looking for. When it goes under 20, that's when you want to be actionable. When it goes above 30, that's when you want to be actionable. That trend literally worked the entire year. Will it work in the year coming? I can't predict that, but as of right now, that has been the trend, and you'll hear it many times from many different investors. There's going to be times where the trend is your friend. All right. What did the crypto market tell us? Bitcoin is way down. Ethereum was slightly up at 0.39%. Nothing crazy there. Then you have XRP staying kind of flat, which means it's not going up too much and not going down too much. All right. So next, let's look at the fear and greed index. Where did the fear and greed index end on the last trading day of the year? And we ended on the fear side, but it's still up from extreme fear when we were at earlier in the year. So people got more pessimistic. One of the things that affects this is tax loss selling, which occurs towards the end of the year, roughly around December. One thing that we did not get this year that a lot of people were anticipating was called the Santa rally, where the last from the 23rd all the way through the last trading day of the year, it's all green days and we end end on a higher note. That did not happen. So that's another thing to keep in the back of your mind. All right. What about the crypto fear and greed index? Where does that? Well, we're currently at 25, which is extreme fear, but there's a lot of things that have to go with that. We still need regulation in this space. We still need a lot of things to happen. We don't know what's happening with XRP, although the SEC versus XRP may come to a culmination very, very soon. Then you also have what's going on with Sam Bankman-Fried and FTX. So that's a lot of unknowns that are keeping these prices down. I still foresee 2023 more downside for these. All right. Bitcoin looks attractive anywhere under 12,500. I have not touched it this year at all. So that's just something to keep in mind. That's a price target that I'm looking at. That's not a go all in price target. That's just the price looking at charts and stuff. That's what's telling me is a very realistic future for Bitcoin. And then, once we get towards the halving cycle in 2024, prior to that, about 6 months, then we should see that run up to about 20,000. But not anytime soon, not in the first quarter or second quarter of 2023. All right. Fed funds rate has really been a big topic of discussion this year in all markets, and it's affected everything from bonds to stocks to crypto to real estate. All right. So what does it mean? The interest rate at which banks and other depository institutions lend money to each other, usually on an overnight basis. This is called the overnight market. The law requires banks to keep a certain percentage of their customers' money on reserve, where the banks earn no interest on it. Consequently, banks try to stay as close to the reserve limit as possible without going under it, lending money back and forth to maintain the proper level. So the federal discount rate is used to control the supply of available funds and hence inflation and other interest rates. Raising the rate makes it more expensive to borrow. That lowers the supply of available money, which increases the short-term interest rate and helps keep inflation in check. Lowering in the rate has the opposite effect, bringing short-term interest rates down. So currently, the Fed funds rate target is 4.5. The consensus a month ago was 4, and we raised it 0.5%. Now, my prediction is going to be February, the next time the Federal Reserve has a meeting and they have to make a decision on what to do. They are going to raise it 0.25%. That is my prediction. After that, I foresee them holding it there at 4.75, or maybe doing 2 more hikes of 0.25 until we have a Fed funds rate target of 5. And then once we get that, we'll hang out for a while and see what inflation does. Hopefully inflation continues to come down. Once we get inflation either 2% for a while, or if we rapidly go under 2%, then and only then do I foresee the Federal Reserve, namely Jerome Powell, saying, you know what? We are pivoting. We are going to shift back into monetary easing, which means they're going to start bringing that Fed funds rate back down. And that's when you'll see stocks that'll start to outperform. Stocks like Amazon, Apple, Facebook, Berkshire Hathaway being one of those as well, because they're in a market that is affected by this as well. All right. But should you invest in these companies? Should you invest in these companies now to try to get ahead of what's going to happen? I don't know. This is what I'm looking at. All right. I want to share this with you. I've been looking at this. I haven't heard it from no one. I haven't heard no one talk about this. This is what I've been looking at. How much cash do these companies have on hand? And this is one thing that is very alarming. And I even though some of these companies you hear have a lot of cash on hand, which you think they call it fortress. Their balance sheets are a fortress, which means they're impenetrable. They're not going to be harmed by the moves of the Federal Reserve. However, when I look at the last few quarters of what has happened we're going to look at a few companies, but for example, Amazon, one of the strongest companies in the world, especially the United States. When you take a look at this, we see that in 2019, they had cash on hand of 55,000. All right. And then just like a lot of us, we weren't allowed to spend a lot of money during the pandemic and all that lockdowns. So a lot of savings accounts went up and the cash on hand for these companies went up as well. So it's a trend you're going to see. But on 2020, you had 84 billion cash on hand for Amazon. 2021, they had 96 billion cash on hand. Now, since then, a year later, 4 quarters later, Amazon cash on hand for the quarter ending in September 30, 2022 was 58 billion. And that is a 25% decline year over year, which means they took a 25% hit, which means that if this occurs for 3 more years in a row, they're going to go down to a negative cash on hand balance or something of that nature. What about Apple? Apple was one of the ones that had the most cash on hand. They didn't make any huge purchases of anything. So let's see what about them. So we'll take a look at Apple. Apple cash on hand was 43 billion. Now that was a decline of 22.89%. And again, that like going towards like what Amazon was doing, they had 25%, almost 26%. So they're right above that, above 20% decline year over year on cash on hand, which means they're spending a lot of cash. Where is that coming from? Where are they burning all this cash? My thoughts, I think a lot of it has to come to do with logistics. Since China was locked down, they had to pay a lot more money to try to get all these devices and things to come back to the United States, and that costs a lot of money. All right, so as you can see, they had an incline just like Amazon did, but then decline, decline, and decline. What about Meta Platforms? So what's that? 48 billion. All right. What about Meta Platforms, which is the parent company of Facebook? They have about 41%, which is pardon the interruption, but you can see that they're burning a lot more money than a lot of their other companies that they're competing with, namely Amazon, Facebook. Their Facebook is burning a lot more money than they are, and but this is a lot of openness because they've been open about it. They've been telling us that they're spending a lot of money on the metaverse. They've invested 20 billion, and they plan on doing about another 8 billion the next year to try to compete inside of the metaverse. So they're at least telling us where their money is going, and that's a pleasantry to hear there. All right, so you can see that they had 54 billion cash on hand, then they had 61 billion in 2019, 47 billion in 2020, and then now they have 41%, again a 28% decline year over year. Now Berkshire Hathaway, Warren Buffett, one of the most important companies in the world as well. They own a lot. What is their money doing? All right. So this one is scary here because they're supposed to be the most responsible ones out of all of them. But what are they doing? 2019, they had 64 billion. Then they had a decline of 25%. What happened there? They sold a lot of their stocks for a loss. They sold American Airlines. They sold some of their fuel companies. A lot of them, they took a loss on these. All right. Then Berkshire cash on hand for 2021 was 88 billion. So an 83% increase. But fast forward year over year, they had a 53.88%, over a 50% decline year over year on the cash on hand. So that is not something to just, say is not a big deal. That is a big deal because this is one of the most responsible companies in the stock market. Like Berkshire Hathaway is world renowned. Warren Buffett, world renowned. Charlie Munger, world renowned. They don't just do things willy nilly. They don't invest a lot of money in research and development. What they do is they lend money. They try to bail out companies that deserve to be bailed out, and they invest in companies themselves. So where is their money going? That's one thing you want to look at before putting money into them. All right. So just keep that in mind. Then you have the S&P 500 chart, which is something that I wanted to look at with you all as well. So let's take a look at it. So we have the S&P 500 kind of over here bouncing on this 3,800 level is the one that I've been looking at. So if we start the year off first quarter and we can't break that $3,800 level, that's going to be a very bearish sign. And I wouldn't be surprised if we went back down and retested the lows of 3,300. All right. So that's something that's very, very that can happen this year. We can retest these lows down here. It was about 3,300. So do not be surprised if we go back down. And the last thing we're going to look at is the Shiller PE ratio, which tells you how much you're paying for companies in the S&P 500. And as you could see, times where the PE ratio was super high, it was time to sell during those times. And when it was really low, those were times to buy. Right now, we're sitting at 28.09% PE ratio, and that's of the last closing day. When you look at your companies, you want your companies to be underneath here. Right now, you want to even be underneath the median, which is 15.9. So when you're investing in a company, you want their price to earnings ratio to be underneath this. Now, if you get a price to earnings ratio of like this one right here, which is 4.78, that's not good either. You want something around 10 to 12% in this current market. All right. When the Federal Reserve changes their policy, that's when we're going to be looking up and saying, it's a completely different story. But I want to know what you all are thinking. What are your moves for 2023? I want to know what you guys are going to invest in. Are you going to invest at all? Are you guys buying properties? Are you guys opening a business? Let me know in the comments below. We are all curious. We want to know. Again, thank you for your support. As always, invest in me and press that like button. Invest in yourself. Smash that subscribe button. It literally costs you nothing. Until next time.